Hello ladies and gentlemen, welcome back to the FT's headquarters for PWM's expert series on multi-asset investing, filmed in partnership with Generali Investments. In Chapter 1, I will discuss with Cedric Baron of Generali Investments the evolution of the multi-asset approach. Most investors have a requirement for both regular income and capital growth. Is it your view that the best recipe for these outcomes is actually mixing different asset classes together?
So I think yes. By mixing different asset classes, it's probably the best way to harvest attractive income probably in a way to optimize your risk-return profile. So by being able to diversify your portfolio, you can increase your expected return for the same level of risk or decrease your risk for the same level of expected return. Currently, it would be a shame not to take advantage of long-term decorrelation between equities and bonds in order to optimize, to increase your expected return at each level of risk you can take. So I do really think that diversification is key. Then, in each equity and fixed income bucket, you can try to generate additional alpha with picking within your portfolio, but then overall, you still have to keep a well-diversified allocation to optimize your risk return.
So this combination that you talk about between equities and bonds, it's been in existence for many years, the old style balanced portfolios. How does the new multi-asset investing compare to the perhaps more primitive balanced portfolio system of the 1990s?
No, you're right. I mean, diversification is not new, but I would say that before portfolio were probably much more close to a buy and hold strategy with balanced portfolio, as you were mentioning, such as 60% in equities, 40% in bonds. And this kind of allocation were performance in the long term, but even whether quite performance even in a short period of time, because equities were delivering positive returns. Then I think we went through quite a different environment since the beginning of the 21st century. The buy and hold strategy is no longer relevant for investors. In 2008, it was no more suitable for them to just keep on their position, probably lose something like 30 to 40% without changing the allocation. They clearly need to have a much more dynamic allocation. And that's what the current multi-asset funds can propose, much more dynamic allocation. Due to different type of methodology, but especially due to reactive, dynamic, tactical asset allocation, in order to improve the expected return in the short term, to catch opportunities and to reduce some exposure when the market is facing sharp drawdown. The other point I think is that the risk management has become a cornerstone in the multi-asset funds. Due to this 2001, 2008 sharp drawdown the investor faced, now fund managers have clearly to settle a sound risk management mechanism in their portfolio in order to avoid any sharp losses, because as you know, when sometimes losing less in the short term, unable to earn much more in the long term. So it's really the risk management is also probably one of the main improvements we had in the multi-asset space.